Just a small caveat. We did prepare the slides last week. A lot of things have changed for the last 1 week. Because we know the war has started again. It has a huge impact on the global economy and, of course, Kenya's economy as well. So we expect oil prices to go up. They've already gone up. They were $70 to the barrel last week, and already 78 as we speak of today. And IMF and the World Bank have predicted that this will hit about $90 in the next couple of weeks. So expect the fuel prices to go up. This will expect also inflation to go up. And all the central bank governors globally keeping a key eye on this to see when they will increase the interest rates. Of course, for Africa itself, most of us import our oil. So that will also have an impact to us locally. So I think it's going to be interesting to see what the Central Bank of Kenya is going to do to interest rates. And we expect the interest rates to actually go up and the inflation will go up as well. Global economic outlook, as I mentioned, Kenya didn't do so well last year. Our growth actually came down from 4.7% to 4.6%. And it's expected at about 4.5 and 4.7 going forward. But I think what is interesting to see is the growth of India. I think India is expected in time to come. But also what is important to understand that our economy is quite small compared to the Western world. So the growth rates of 1 and 2% in the Western world is quite reasonable. I'm sure we are all thinking as to how we can improve our growth. But of course, we have a number of challenges because we have impacts of whatever is happening globally in terms of interest rates, exchange rates. We are our economy is more based on agro, so our climate also affects us as well. So, but of course, we need to see how we can improve Kenya's economic growth going forward. But we will see how we can tackle the challenges that come forward to us. On the global commodity prices, I think we are all aware of what's happening around the world, as I mentioned earlier. If you look at June 2022, just after COVID, the price of crude oil per barrel was almost $120, which created a lot of inflation globally. It has come down over the years. It has been yo-yoing. This is all based on the wars that UK placed. Remember, in August 2023, it went up to almost $95. That's when the war with the Ukraine and Russia started. That had an impact globally as well. It has been coming down. It had come down to almost $61 in December 2025, which was good news for us. But unfortunately, in February, March, the Iraq and US and Israel war started, and it spiked up to $102. We had the peace agreement, which came in last month, brought the price down to almost 86. As I mentioned earlier, it came down to almost $70. Then again, the strike started, and it's gone up to about 78 as of today. We just have to keep an eye on this. As I mentioned earlier, and I keep on mentioning this going forward, this will have a huge impact on our economy, because this will create inflationary pressures, which is not good for us. Cost of living will go up, and of course, even expected interest rates will go up as well. Again, the same thing on the headlines, CPI inflation rates. You see the rates are very, very stable. Coming back just after COVID, the inflation was extremely high globally because a number of Western governments had given a lot of funding, especially in the UK, where we had furlough payments, and even in the US, because most of these Western economies are consumer spending driven. So people or the consumers need to have money in their pockets. So it drove up inflation. Interest rates were extremely high, and that has actually brought it down. But you can see in the month of March and May, it has gone up slightly, again because of rising oil prices that happened because of the Iraq war. Down to 3.7%. Our projection for 2026 is about 4.4%. It's going to be interesting to see whether we can manage the 4.4% globally, or will this hit about 4.85%. It all depends on how the war goes on, and for how long it goes on, and what other impacts it could have globally. So we just have to keep a key eye on this war itself. Just trying to explain again on the global inflation versus interest policy rates. And when the inflation actually goes up, the central bank governors globally have a key eye on the inflation rate and then they manage the monetary policy. Then, if the inflation is going up, interest rates are expected to go up. So, as I mentioned earlier, look at all the economies in the US, UK, India, Japan, where the interest rates post COVID was 0%. They had to take up the interest rates to almost 5% because the inflation was extremely high. For example, in the US and the UK, the inflation had reached almost 8 to 9%. So by bringing up the interest rates up, the inflation has actually come down, and again, it's going up because of the increase in the volume. Coming back to Kenya's economy, we are an agro-based economy. We are all aware about it. So for us, what is important is the climate. We just need to make sure that we have enough rains, we are productive, we have enough fertilizers. Fertilizers is a big issue for the country because Iran is a big producer of fertilizers. For example, Iran exports 40 to 45% of fertilizers to India. India is also an agro-based economy as well. So I think that has an impact on our economy because the price of fertilizers will go up. So we have done well in terms of agriculture. It is a big sector. We've grown from 2.4 trillion to almost 4 trillion. And the next big one is the transport, financial, real estate also. So all our sectors are actually doing well. Manufacturing could be better, but we'll talk about that in the next slide. What is, of course, interesting is the accommodation and food service activities. We've seen a lot of tourists coming into the country, a lot of conferences. There's also a lot of focus on tourism as well. And we've also seen a lot of development of hotel industry in Nairobi. We've seen the big brands coming into Kenya itself, so which is a good sign. But we, of course, we need to make sure that we have a stable economy. In this time and era, we just need to make sure that our political activities are not as bad as they should be, because we've already lost 4 days in the year just due to protests. And we are all aware that when negative news now that is a good sign. So we are very much focused on agriculture. On the domestic front, again, highlighted a couple of areas. Again, manufacturing, I don't think we're doing so well. I think the main concern from a lot of companies and Kenya Association of Manufacturers is the cost of doing business in the country is extremely expensive. Our electricity is very expensive when we compare ourselves to Egypt and South Africa. And a lot of people say that it's cheaper to import stuff than to manufacture in the country. I think that's an area which the government needs to critically look into. The area of taxes is also another concern, because a lot of hidden taxes, especially I understand Myanmar have brought in a lot of taxes when importing goods into the country. We look at excise duties, and some of the tax rates are not competitive for us to manufacture in this country. Mining and quarry is also doing well, and it's expected to grow by about 9% in time to come. There's a lot of focus on gold. We have seen a lot of interest in gold from overseas companies, overseas countries as well, and overseas entities as well to the country. So we are hoping that will take off in time to come. We are hoping also in time to come we will see oil. Kenya will be an oil producing country. We've spoken about this in the past as well, but we just have to wait and see how this performs. Of course, the fastest growing is the accommodation and food services. As I mentioned earlier, Kenya is doing a lot of conferences. A lot of hotels are coming up. That's growing very, very well. Again, the real GDP growth, I emphasize, we have not grown. We have actually stabilized from 4.7% to 4.6%. If you look at 2021, just post-COVID, we were 7.6%, and then we're just at about 5% growth. So the question that we need to ask ourselves is how can we improve from 5%? How can we take it to first to 7 to 7.5%? Because we have a high debt level as well, which we need to make sure that it is sustainable in time to come. So I think the other sectors are quite okay. Agriculture is expected to grow at about 4.5 to 5%. But I think these are the key sectors we needed to highlight, and that's where the focus is from the government. Projected domestic economic growth, when you look at the budget, it's expected that the nominal GDP is expected to grow by about 10% on year-on-year basis. So by 2029, Kenya is expected to have a 28 trillion economy, right? And our real GDP taking into consideration inflation of roughly about 4.7%, so real GDP is expected hovering at about 5.3% on average. So keep an eye on this. There's a lot of funding available. We are hoping there are lots of opportunities. How the GDP is growing. Just to alert you that Kenya is the sixth largest economy in Africa. So it's not everything negative about Kenya's economy. We also have to be proud that we're the sixth largest. We just have to make sure that how we can get closer to Morocco and Algeria, who are fourth and fifth as well. Tourism. I think there's a lot of focus on tourism from the government. And they've anticipated, and the target is that in time to come, we want to have 5 million tourism into the country. We are looking projected for 2027 is close to 3 million tourists. We are sitting at about 2.7. Of course, we are all aware of what happened after COVID. We have been revived now, but this is improving. This is increasing. We've seen a lot of branded chains coming into Masai Mara. We're also seeing a lot of branded chains coming into Mombasa and elsewhere as well, which is good news for the country. Because the Western world prefer branded hotels, and when we see big brands coming into the country, that's a positive sign for the economy. The only concern again is we just have to make sure that we are competitive because our neighbors are much cheaper, and they also have branded hospitality and good hotels as well. We just have to make sure that we are competitive because we know how price ourselves, we lose out our market share to our neighbors. Again, this is the same discussion that we had earlier. And when we look at the global tourism, about 1.52 billion people travel the world. It's a big, big market for us. And when we look at the Western world, France is the leader, France, Spain, United States, Italy. It's just the way they do their business, and it has been growing. And 102 million people visiting France, that's more than our Kenya's population, which is at about 55 million people. So we need to ask ourselves, what are they doing different? What could we do better ourselves? When we look at Africa, Kenya is not too bad. Zimbabwe has climbed up the ladder. But we need to see what is Morocco doing differently, what is Egypt doing differently, what is Tunisia, South Africa, Algeria doing differently. And we need to learn from these countries to make sure that we are competitive. Of course, there are plans to have a major airport as well. There are plans to market Kenya as a tourist destination. And we are hoping that in time to come, we will have 5 million tourists coming into Kenya as well. But as I mentioned earlier, in this time and era, the Mandamanos, the political environment, we need to have a very, very stable environment. We need to reflect a positive image of Kenya overseas, just to make sure that we get more tourists. Because negative news travels very fast. We don't want to have negative news in the mainstream media, and we don't want to have. And I'm quite hopeful that we should be able to hit that 5 million tourist target in time to come. But I believe that Kenya is a beautiful country. Inflation expectations and projections. Again, the Central Bank of Kenya have their own targets. They have a lower end of 2.5% to 7.5%, which I believe they have done extremely well for the last couple of years. And again, as I mentioned to you, the rates were extremely high in 2022, 2023. This was again coming just out of COVID, and this was again coming from whatever was happening in the Western world, where the rates, as I mentioned earlier, was about 8 to 9%. And again, the interest rates were increased in Kenya from 7 to 10%. And we're all aware in February 2024, the infrastructure bond of 18 to 19% was issued. And that brought down the inflation rates down, and it's been very, very stable for the last 2 years. Again, we are expected to be within the range of 2.5 to 7.5%, which is good news. But of course, there are challenges from IMF. The IMF has challenged our inflation rate. because they feel we are not giving the true rate or we are not issuing the true rate. The challenge is being that they seem to say that we have a flawed forecasting model. We don't have enough macroeconomic data, and it seems that the information is not coming on a timely basis. So they are working with the Central Bank of Kenya to rebuild the model, so just to make sure that we are giving the true inflation. So I think this is an important area, because if our inflation is incorrect, then the interest rates in Kenya is also incorrect, and that would have repercussions to the cost of living crisis, would have repercussions on the macroeconomic stability of Kenya's economy as well. So I think they're all working together, and I think in time to come, we hope that our inflation rate will be truly to what is being reflected in the down levels. Again, monetary developments, as I mentioned, the rates were between 8 to 10% in 2022. Inflation went up, the rates went up again. These are the treasury bills, and the rates have come down. And then you can see in the month of March and May this year, the rates have gone up slightly. The treasury bill for about 365 is now just hovering close to 9.5%. That's basically because of the inflation which has gone up, mainly due to the oil price and the Iran war. Yeah. We just have to keep an eye on this again. We just want to make sure that we are within. And for those businesses which have borrowed from the banks, expecting inflation keeps on going up, your interest rates from the banks also going to go up, which will have an impact on your local businesses. So please keep an eye on what's happening in the Middle East, and we see how this will reflect going forward. The same applies to the commercial lending rates. I'm not going to spend too much time on that. Again, it was low, went up, they're going down. Again, these rates will be going up. It all depends on how the oil price will behave going forward. On the monetary developments, on the government side, it all depends on how the government wants to finance its activities. And if you look at the chart below, look at June 24, 25, and 26. When the rates were extremely high, what the government wants to do is wants to make sure it doesn't tie itself into long-term bonds, because interest rates are all short-term. So they've gone about initial short-term bonds at times over 2 years, 3 years, 7 years, right? As time has gone by, interest rates globally has come down. Inflation has also come down. In the years 2025 and 2026, the government or the Central Bank of Kenya has gone back to the market and started issuing long-term bonds, even long-term bonds to the extent of giving for 29, 30 years. Unfortunately, because the economy is not doing that great, there is a lot of surplus funds. The credit given to the private sector has been low. So the banks have been sitting with a lot of cash, and most of the bonds that have been issued by the Central Bank of Kenya have been oversubscribed. So they have done well from that perspective, but I think the important message is that we don't have a situation that the private sector is crowded out. The banks just start lending to the government. So we just need to make sure that the right balance is found. Coming back to the current account balance, Kenya's current account is always negative because we export less and we import more. And I think this is a concern where the Central Bank of Kenya governor, Honorable TK, has raised, because when you have a currency which has depreciated over the years, we expect exports to climb, right? Because our neighbors are doing much better. In fact, we're actually now importing more from our neighbors now as well. So I think that's an area which the government needs to focus and to see how we can improve on our exports. But of course, there are challenges. When our tax experts speak about export, the people who export, the VAT difference is a big issue. The delays in paying VAT refunds, the taxes, the cost of doing businesses is a challenge. But I think that's an area which the government needs to look at critically and to see what we can do to support companies which export. But remember, the companies which export, they bring in foreign currency into our country. That helps us to manage our exchange rate. Goods and services balances. So we are down by 8.9 million US dollars. And of course, we have the primary and the secondary income. Our financial capital account is also negative, but actually it's actually positive. That helps us to balance our current account. And that's basically because of our diaspora income. I think basically the slides just show that we need to see how we can improve on our exports. Because we can't have a current account deficit entirely, because that puts pressure on the exchange rates. Our diaspora remittances, right? The people, Kenya has become a country where we export labor. Of course, a lot of changes taking place in the Western world because of immigration issues. The number of people who are living in Kenya has reduced as well. Migration, because of all these policies which are coming into place. But it is good to know that the diaspora income is estimated at about 55 billion shillings per month, right? And of course, our biggest diaspora where the income comes from is from the US. We've got US, we've got UK, we've got Australia, we've got Europe. We have a lot of labor which we've exported to the Middle East and also to Saudi Arabia. And we are hoping that this will continue. But of course, the question that we have to ask is why do we have to export our labor when we actually were giving free education to our local children? So we need to see how we can retain that labor into Kenya, which can help us to grow faster. So that's an opportunity for the Kenyan government. Our foreign exchange reserves, I think we have done very, very well in terms of exchange rate maintenance. At one time, we were at about 4 months of import cover. This has improved drastically to about 5.6 months over the years, which is extremely good for us. And we are all aware that the government is coming into play and the Central Bank of Kenya is coming into play to manage our exchange rate. As you can see from the slide, that our Kenya shilling to the dollar has been very, very constant for the last 2 years. There have been some concerns raised by IMF and World Bank that you can't have an exchange rate which is so stable when inflation is hovering between 5 to 7%. So technically, if you are technically making between 13 to 14% in real terms, if you have invested in Kenyan bonds, and if your exchange rate is very, very stable, you can say that you've actually made 13 to 14% in terms of US dollar. Yeah. So I think we just have to see for how long this exchange rate can be maintained. Of course, the import bills are going to go up. The oil price goes up. There will be coming to government debt. I think this is a big focus globally, also for Kenya itself. We just have to find the right balance. The government is always in a deficit because we spend more than what we collect. The Kenya Revenue Authority is always under pressure to collect more revenue. They always don't seem to be meeting their targets as well. The government has some sort of a bloated government. We have too many ministries. There's too much of traveling. I don't know whether there's any control on expenditure as well. So we have a big budget. We have a 4.8 trillion budget. And how are we going to sustain that going forward? Sector allocations, 4.8 trillion budget. From the 4.8 trillion budget, 1.5 trillion is just going to go to pay off interest, pensions, and net lending, which is almost 31% of what we are going to spend, which is huge, in my opinion, because paying 13 to 14% is quite high. Then the next sector, of course, is education. We have the free primary education. But as I mentioned earlier, that we're educating our young children free of charge. But instead of utilizing them to grow Kenya's economy, we're utilizing them to grow the Western world. So, which I feel is not fair. We should see what we can do to improve foreign direct investment, create employment, and make sure that we retain talent into Kenya. And of course, we have energy, of course, the counties, which is about 9%. As per our constitution, it's supposed to be about 15%, so about 430 billion actually is given to our 47 counties, and the rest follow through. So 1.5 trillion, ladies and gentlemen, is quite a significant figure on spending. So that's why you see that the banks, we have a lot of mutual funds coming into play. That's where they make the money, right? So the banks basically ask, why should we lend to the private sector when the government is in need of the money? So I think that's an area of concern. And we are hoping in time to come that we shall be able to grow Kenya's economy. we should be able to control our expenditure so that we're able to reduce our interest payments. Again, this is an interesting chart. We are expected to between 4.8 trillion. Our revenue is expected to be at about 3.6 trillion. We're raising it ordinary at about 3. We have appropriation in 8, and we have the grants. So our total financing requirement for 2026-27 is about 1.2 trillion. And what is interesting to note there is that the total financing is going to be done domestically. A lot of people who will not be able to borrow from the banks. The banks will be more interested in lending to the government. They can get their feet up because when they lend to the government, it is expected that it is risk-free. Yeah. And as I mentioned there, the interest expense, the percent of total revenue is 34%. Another ratio that we need to look at critically is the percentage of revenue as a percentage of GDP, that is a tax revenue, which is hovering at about 17 to 18%. And there's a lot of pressure from IMF and World Bank to increase this to about 21 to 22% in time to come. But we are all aware that when we tried to do that 2 years back, we had the Mando. The entire finance bill for June 2024 was rejected. So again, the government has to find the right balancing act. We are also all aware that we have an election year next year. So the government is trying to be very, very careful to make sure that we don't increase direct taxes. There are a lot of indirect taxes, which my colleagues will talk about in the next session. This is an interesting slide as well. We can see our total revenue going up in terms of the tax revenue. At the same time, our recurrent expenditure is also in line increasing as well. But what you see is a flat line for development expenditure. So that's why you see that most of our roads don't get developed, most of our bridges, most of our infrastructure don't get done. And what we have seen from previously is if the government or if the Kenya Revenue Authority fails to meet its tax revenue, what happens? They cut down on the government on the development expenditure. Yeah. So it's an interesting slide. So the gap between the recurrent and the development is widening. And the recurrent expenditure is a sunk cost, and the Kenya Revenue Authority is under tremendous pressure to increase their tax revenue, just to make sure that the recurrent revenue is managed or is sustained. Looking at the fiscal performance, again, this is just a budget. There's always a tendency that the current account or the fiscal deficit will actually reduce in time to come. But again, if the Kenya Revenue Authority does not meet its targets, it's very doubtful that we will be able to achieve the 5.3 and the 3.6 and the 3.3 going forward. I expect the fiscal deficit to remain at about between 5 to 6% going forward, unless the government think tanks changes. Kenya's economy grows between 6 to 7% in time to come, and we are more efficient. And of course, we've seen lots of changes from the Kenya Revenue Authority in terms of making sure that we get more taxpayers on board. Use of artificial intelligence, use of e-teams. Kenya's debt outlook, again, these are just projections. Our outlook is expected to reduce to about 59%. Our debt levels are sitting at between 12 to 13 trillion. So we're just close to about 68%. And we are hoping that our GDP will grow, and we are hoping that we will be able to manage our fiscal deficit in time to come. That will help us to reduce our debt ratio to 59% in time to come. Again, this is a caveat. I keep on saying that, and I will keep on repeating that our growth has to be sustained. We need to grow more than 5% to make sure that our debt levels are sustainable. And we are hoping that the government will be able to manage and control its recurrent expenditure. Again, what is important is the growth level from the budget. The expectations are that the 61% of our debt will be from domestic levels, 39% will be from overseas, will be from external debt. So again, I get really concerned that we're going to have a crowding out effect, and the banks will not be really willing to give money to the private sector. So I think that's a concern for me personally, and I'm hoping that the Central Bank of Kenya and somebody from National Treasury will be looking at these numbers very, very critically, and hopefully we will try and reverse this situation. Just giving a little bit of history from the retired President Uhru's tendency of government. We had a debt anchor of 50% of GDP. And of course, Parliament and said we don't have a percentage of GDP, we want to have a ceiling. We improved from 9 trillion, we went to 10 trillion. Then to manage our debt levels, we've now gone to a ceiling of 55% of GDP. So as we speak right now, our debt levels are close to 12 to 13 trillion. And as I mentioned earlier, our domestic debt levels have now increased to 56%, and our external debt is now 44%. If you look at the same chart last year, it was close to 50%. And the main reason being is because there are discussions with the IMF and the World Bank, which we will discuss about later on. And you also have the Eurobonds. I just did a small working that we have Eurobonds of about 8.7 billion to 2048. And one of the reasons why the Kenyan government also shined from external debt is we're all aware of what happened 2 years back. Kenya shilling depreciated significantly. Our dollar hit almost 1.7. Interest rates, the Kenyan government is very wary of the depreciation of the Kenyan shilling. So if the Kenyan shilling is at 130, our amount in Kenyan shilling is 1.14. If the Kenyan shilling depreciates by 10%, right, we take an exchange loss of 114 billion. If it depreciates by 20%, the Kenya government takes a hit of 228 billion in exchange rates. Yeah, so that's why it's important. Other important issue, as I mentioned earlier, is the IMF have stopped funding the government because there are some unresolved governance and corruption reports. They are also not happy with the way the public debt is being reported because a lot of questions are being asked by Wananchi as what is the true level of our debt. There has been pressure as of last week where the World Bank has insisted that the pending bills worth Kenya shillings 588 billion should be part and parcel of the public debt. There's also been concern of the level of debt held by parastatals that should also be accounted for as part of public debt. So I think this is an important conversation which the government, World Bank, and IMF are having. What is the true level of the public debt? Now, of course, we have reached previous loan targets. There also has been domestic political fallout and policy shifts because there's a lot of pressure, we're all aware, from IMF and World Bank. As I mentioned earlier, they want the ratio of tax revenue to GDP or the tax revenue to expenditure to go up from 18% to about 21-22%. That means increasing taxes, and that creates a political issue, especially when we have elections next year. So I think keep an eye on what these talks do hold. We're hoping in time to come, we should be able to resolve it because even the World Bank is now getting involved to see how we can manage the situation. What is interesting now is also that when we went to the National Treasury website, we found this page that you can keep an eye on Kenya's external debt. So you can go to the Public Debt Management Office. It's available on the National Treasury for those of you who are interested. So it shows very clearly that as of December 25, our total debt external is about 5.46 billion. And it also gives details as to whom we are owing the money. Okay, so I think it's quite interesting. But of course, what is important, we just have to be comfortable that we can trust these numbers and we can trust the Central Bank of Kenya and we can trust the National Treasury. These are some clips that we picked up from the. There's a lot of wasteful expenditure in government and there is a lot of tax collection pressure. What was important is when I picked up this court revised debt for KL to recover 476 million. I think this was quite interesting. This was a firm which was actually dissolved, and the court has instructed the registrar of company to reactivate it so that the KRA can follow a debt of 476 million shillings. I was asking myself, what would happen if an individual died? Would the court direct that individual to get alive? I don't know what would happen in that case. But I think it's interesting to see that these are the kind of scenarios that are taking place. These are the pressures KRA is under to collect debt. We've also seen a situation with Del Monte regarding exchange treatment of exchange gains and losses on a loan which was paid, where Del Monte actually won the case in court. There has also been a situation on the tribunal. This is again relating to Kenyan, where dividends were actually paid out or where taxes had not been paid. But taxes were not paid because they had significant tax allowances. But KRA has objected to it and tribunal has favored the KRA. So I think please be aware that the tax in Kenya is becoming extremely complex, and the Kenya Revenue Authority is trying to look at each and every loophole to try and see how they can pursue so they can improve their tax collection. Thank you for listening to me, and I will hand over to Kevin, who will take us through the income tax proposals.
Thank you very much, Alpesh, for that detailed presentation. And I want to pick it up from where it stops in terms of taxes. And just to mention that you highlighted that the budget for 2026-2027 is 4.8 trillion, with about 2.9 trillion coming from ordinary revenue, which is taxes. And out of that, the Finance Act 2026 is targeted to collect about 100 billion shillings from that. So in the next session, we'll see what are those measures that were introduced by the Finance Act 2026 that are aimed at the revenue collections of about 100 billion shillings in the coming financial year, which already started on Wednesday of last week. So as you realize, most of these changes have come into play or in place from 1st of July 2026, with just a few changes coming into place in 1st of January 2027, which we'll highlight, and just look at those changes. So we'll take our presentation from a point where there were some proposals that were in Finance Bill 2026 that were enacted into law through the Finance Act 2026 without any amendments. And some of those changes include the issue to do with the definition of immovable property, in particular in relation to companies or entities that are engaged in the extractive sector. So where you have land that has what we call mining rights or petroleum rights, and you transfer that land, initially it was taken that for the whole transaction will be taken for capital gains taxes. What the Finance Act has provided is that if you just transfer the mining or the petroleum rights or the exploration rights without transferring the land, that will also be taken into consideration for capital gains taxes. And this is just towards making sure that you don't avoid taxes through what we call technical arguments, where you can say that just transfer the rights without transfer of land. So for those people in the extractive sector, please take note of that. I want to take the next two amendments together because they are coming on the background of some court cases that the government through the KRA has lost. And what we are seeing is a scenario where the government loses a tax case, they change the battlefield. So in terms of this is that we had a notable case on Barclays Bank where the Supreme Court ruled in December 2025 that any interchange fees or merchant fees on cash transactions or any payments made in consideration for use of a digital payment infrastructure for cash transactions were not subject to withholding tax simply because they were not management fees or professional fees or royalties, respectively. Now, we are seeing a scenario where the government has gone to change the battlefield, and they are put it expressly in the Act that those two transactions are subject to withholding tax. There's management and professional fees, and there's royalty respectively. So going forward, from 1st of July 2026, these two transactions will be subject to withholding taxes at the respective non-resident or resident rates. And the implication of this is that ultimately the cost of that transaction will be passed on to the final consumer for those services. In relation to the betting and lottery industry, is that whatever you make as a withdrawal for betting and gaming competitions, whatever is paid out or whatever is paid out from prize and lottery competition as winnings will all be subject to withholding tax, including the amount staked. So what the government here is looking at is that, withholding tax is the easiest tax to collect because it is taxed at source and the obligation is made on the person who is making the payment. So whenever there is a payment for pricing, competition, betting, and any other form of lottery, will be subject to withholding tax, including any amount that is taken. So any payout will be subject to withholding tax. On gratuity, if you recall, through the Finance Act 2025, there was the introduction of tax-exempt gratuity, and subsequently KRA issued a public notice noting that that gratuity that was exempt is any gratuity that is earned from 1st of July 2025. Now, to provide more clarity on this, the Finance Act 2026 has provided that that gratuity that is exempt will only be exempt to the extent that you have been in contract of service for more than 3 years, and it will be cut to 31% of your emoluments that you have earned within that period. So we are seeing a scenario where the government is giving on one hand and taking something on the other in terms of the tax exempt gratuity. On rental income tax, there is the introduction of the simplified rental income tax by a non-resident person on any property that is owned in Kenya, more or less similar to what we have on the residential rental income tax. But notably, something we noted is that the rate that is applicable on this tax was not expressly provided in the Act, even after highlighting that during our public participation process through the Finance Committee of Parliament. On withholding tax and by shipping companies, just a small clarification that to align it to the other withholding taxes, it should also be payable within 5 days after the date of payment. On trust income, there is now a simplified taxation scheme for trust income, and the Act has provided that the income of the trust will now be chargeable by and any qualifying payments such as qualifying interest, qualifying dividends will not be subject to tax, and subsequently any distributions to the beneficiaries will also not be subjected to tax. A small cleanup in terms of installment tax, where there was a reference to minimum tax, that has been done with because we no longer have the provisions on minimum tax. Still continuing to the changes that were enacted from Finance Bill into Finance Act, we have clarification on interest restriction exemption on deposit-taking financial institutions to provide that where those institutions provide in either lending or leasing business or both will be subject to the interest restriction exemption provisions. On country-by-country reporting, the definition of an ultimate parent entity has been harmonized to what we have the OECD guidelines to provide that an ultimate parent entity will be an entity that is responsible for the ultimate consolidation of financial statements of the entity that is responsible for finding the country by country reports, and where there is no other entity to which it reports to, just as an alignment to ensure that that definition is as per the OECD transfer pricing guidelines. We are seeing a change of mind by the government where last year they repealed the withholding tax on scrap metal dealers. Now they have reintroduced it, a withholding tax of 1.5% for both residents and non-resident persons dealing in scrap metal business. On EACs, citizens, they had previously enjoyed a withholding tax rate of 5% on dividends that is being repealed, and now the default rate of 15% on dividends to EAC citizens will be applicable going forward. On branches and other permanent establishments, remember that in Finance Act 2023, there was the harmonization that branch offices will now pay taxes at the rate of 30%, with an introduction of what we call a branch repatriation tax. So this has now been extended to cover even branch offices and other permanent establishments operating in the extractive and industry under the ninth schedule. We have had a preferential tax rate of 15% on large-scale residential housing developers who would they enjoyed a rate of 15%, and in line with what we have under the national tax policy and the medium-term revenue strategy, that you don't give tax breaks of more than 50%. So we have seen that repeal. So entities that are operating in that industry will pay the normal corporate tax of 15%. Pension payouts due to demise of a person will now be tax exempt going forward. To encourage uptake of the real estate investment trust, the Finance Act 2026 has provided that any transfers of property to a real estate investment trust will be exempt from CGT. On investment allowance, that's a clarity there that any investment allowance on industrial buildings will be applicable at the rate of 10% per annum. There was an issue on how that rate applies, so there is clarity that that will apply at the rate of 10% per annum. A notable provision here that has been enacted is that on capital gains on indirect transfer, so where you have non-resident persons making any transfer that are relating to property that is deriving value here in Kenya, has always been subject to capital gains tax from the year 2023 through Finance Act 2023. Now, this has further been expanded to cover that if you have any transaction that derives value from a company or property situated in Kenya, or where you even have transactions that result in the transfer of an entity in terms of its ultimate managed entity or its group structure, that will be subject to capital gains tax in Kenya. So the take home on this is that any indirect transfers that derive any value from property or shares that are situated in Kenya will be subject to capital gains tax in Kenya. Having looked at that, we have some items that were not the Finance Bill 2026, but through the legislation process, through the parliamentary process of enacting the bill, they were introduced and have found their way into the Finance Act 2026. And we look at those. And one of those is that on the income tax filing timelines, I think this was one of the provisions that brought a lot of individuals, that is persons who are individuals, will be required to file their income tax return by 30th of April every year, declaring any income from either employment or other sources of income. So for individuals, whether you have a nil return or you have a return from employment income or you have other sources of income, as long as you are an individual, the filing deadline becomes 30th of April every year. For corporates, so these are an individuals, they will continue filing their return by the 6th month of the year ends, respectively, depending on when the year end falls due. Now, this is quite interesting because we've also seen a subsequent provision enacted through the Tax Procedures Act that gives the commissioner powers to issue persons with a pre-populated return by the month of January. And the assumption here is that all persons are at December year end. And once you are given that pre-populated return, you have 2 months after being issued. So we are saying that by end of January, the commissioner issues you with a pre-populated return, and within 2 months, so that's by March, you are required to either amend or verify that pre-populated return, and then it becomes the actual return. So we are going to see a lot of issues around this because on one hand, the income tax provides for 30th of April to file your income tax return for individuals and for corporates by the end of 6 months. But then going forward, we are seeing a scenario where the commissioner will be giving you a pre-populated return by January, and you're obligated to either amend or confirm that pre-populated return within 2 months after being issued. Some other notable amendments that were issued, some of them very targeted to Kenya Airways, where there will be the exemption of employment income earned by non-resident persons outside Kenya and who are employed by Kenya Airways from income tax here in Kenya, simply because those persons are also required to pay tax in their country of residence. Also, what we talked about, payments on cash transactions and so forth that are now subject to withholding tax, that withholding tax will not be applicable to the Kenya Airways. There have been some protracted battles about the issue of bad debts for financial institutions. And the main issue was whether the principal amount that is being lended to persons is subject to bad debt deduction under the notice number 37. So, whereas we have had conflicting decisions from the courts and the tribunal, the parliament has put an end to that and provided that that deductibility will also include the principal amount that is being or that is forth not being repaid to by persons who have been given that loan. So the principal amount, the interest, and any other fees that fall due in line with the legal notice number 37 on bad debts guidelines will be available to be deducted as a bad debt. On tax losses carried forward, remember these have become a huge issue for many entities, given that Finance Act 2025 capped tax losses carrying forward to 5 years. We are seeing a clawback on that, given that any entities that had invested more than 10 billion shillings by 1st of July 2025 will be allowed to carry forward their tax losses definitely until those losses that were accrued or earned by 1st of July 2025 are exhausted. To encourage entities make investment in bulk storage of petroleum products and gas storage exceeding 10 million shillings, there is an introduction of 100% investment allowance in the first year of investment to spur investment in that business. For microfinance institutions, now they have been listed under qualifying institutions under the 4th schedule. So if you have any mortgage from a microfinance institution, it will qualify for mortgage relief under the income tax provisions. Finally, another change that has been introduced by Finance Act that was not in the bill is in relation to exempt withholding tax on commissions to non-resident agents securing transport services on international travel tickets. Now, it's important we take also note of those proposals that were in Finance Bill 2026, but did not find their way into Finance Act 2026. And some of them include, there was a proposal to expand the definition that will no longer be subject to withholding tax as a royalty, but subject to business tax as a normal business income. There was another proposal that taxpayers with nil returns, especially individuals, there was a proposal that they define their returns within 1 month, possibly by end of January. That has now been dropped with individuals now, or any taxpayers with nil returns required to file their tax returns within 4 months for individuals and within 6 months for corporates. Another notable provision that has been dropped is on tax distribution dividends, where there was a proposal to cap it at least 60% of distributable reserves. That was dropped, but very important to note that the commissioner still has powers under Section 24 of the Income Tax Act to deem a distribution of dividends where you have not made a distribution, and the threshold of distribution now remains at the discretion of the commissioner, taking into consideration the business needs. So, whereas the bill had proposed to cap it at 60, the commissioner still has powers to deem what threshold they want to distribute dividends, of course, taking into consideration business needs. There was a proposal to offer tax relief on housing loans from Central Bank of Kenya. That one was dropped. Withholding tax exemptions on Kenya Airways on certain payments was dropped, but we have seen an introduction of some other withholding tax exemptions. And there was a proposal that the tax exempt gratuity would not be applicable to employees already under pension scheme. So that has been dropped. So all employees, even if you are a member of a pension scheme, you'll enjoy the tax exempt gratuity subject to the conditions that have been imposed by Finance Act 2026. So those are the notable proposals that have been informed by, or that have been introduced through the Income Tax Act by Finance Act 2026. And at that point, I will pause and introduce my colleague James to take us through the indirect taxes. Thank you.
Yeah, thank you, Kevin, as well as Alpesh, for those informative sessions. And I take this opportunity to welcome everyone to this next bit, which will basically focus on the tax amendments touching on indirect taxes. So the first bit will be on VAT amendments. Then we'll also look at excise duty amendments, as well as custom duty amendments that are introduced through 26. So I think we'll just quickly move in and I'll follow the same format that Kevin used, where we will quickly look at some of those proposals that were in the finance bill that were enacted through the Finance Act 2026. Then we'll also see what new amendments have been introduced, as well as what was dropped. So on this slide, just a quick alignment on the first item, basically where there's the deletion of definitions of assessment, information technology, and computerized system. And this is basically just to align those definitions with the definitions that are contained in the Tax Procedures Act. Then with regards to hire purchase transactions, it is worth noting that any financial charge that is on any hire purchase arrangements is not subject to VAT. The clarification that has been introduced and which was there in the bill is that for any person to enjoy such VAT exemption on financial charges on hire purchase arrangements, then that business has to be licensed under the Hire Purchase Act. So the licensing is a requirement for the VAT exemption to be applicable on financial charges on hire purchase arrangements. Then I think one of those very notable proposed amendments that we saw in the bill was the issue of taxpayers having to account for tax upon change of taxable supplies to VAT exempt status. I think this is quite a profound amendment, because then what this will mean is, as is the normal practice, whenever we are looking at the Finance Act, there are always those situations where items change their VAT status. So it so happens that if the VAT status of a certain item has changed from being subject to VAT at 16% to VAT exempt status, and at that point you have those items in stock, whatever input VAT you had incurred and claimed on those stocks on hand would have to be paid back to KRA. Then on the issue of VAT refunds on bad debts, you must be aware that you actually have that opportunity to claim those VAT refunds. Obviously, there is the whole issue of the challenges when it comes to VAT refunds, but then there is this opportunity. But what the way the law has been amended is basically to extend the period for claiming VAT refunds on bad debts from 2 years to 3 years from the date of submission. Entitled to claim a VAT refund on bad debts if it so happens that the debtor has been put under statutory management or administration. So whichever of the situations comes first, whether the debtor has been put on administration or basically you've had 3 years from the date of supply, you can actually make an application for VAT refund. But I think the profound amendment there is just the extension from 2 years to 3 years from the date of supply before you can actually make a VAT refund application on bad debts. Then there is a clarification that it is only businesses that are making taxable supplies that are mandated to issue tax invoices with VAT. So if you are not a VAT registered person and you are not making taxable supplies, you are not supposed to actually issue a tax invoice with VAT. But maybe just to underscore that point, I think the issue of ETIMS invoices is a critical one. I believe we all saw the challenges that were there with the filing of the income tax returns because of basically having to support expenses with ETIMS invoice. So we still emphasize and reiterate that the issuance of ETIMS invoices is still mandatory for all businesses, because then it has an implication when it comes to the deductibility of expenses from a corporate income tax perspective. There's just an alignment on tax avoidance schemes provisions in the VAT Act. Those have been repealed in the VAT Act, and all of them have been consolidated and aligned with the tax avoidance provisions in the Tax Procedures Act. When we move to the next slide on other proposals that were enacted, basically VAT is now applicable on spare parts for vehicles that are used in official aid funded projects. Remember that official aid funded projects are VAT exempt, which basically means that any input is not deductible, but this is just an expansion of what previously used to be there, touching on motor vehicles that are used for official aid funded projects. So the extension of the VAT on the spare parts is basically to address the fact that the VAT exemption did not cover any motor vehicles that are purchased for official aid funded projects. A very notable amendment when it comes to the VAT exemption status of financial services. You will note that the following financial services will be subject to VAT going forward, and I believe that was from 1st of July 2026. And such financial services include the merchants acquisition fees, gateway or aggregation services, supplied over software or platform for a fee or a commission. I think the most notable change in that in this amendment was that the issue of money transfer was dropped, and that really touched on money transfer financial services, which are still now VAT exempt. So the money transfer services were exempt from this category of financial services that are now subject to VAT. There is an increase in the duty-free allowance for travelers accompanied baggage when they are coming into the country, and that has been increased from $300 to $2,000. Then I think in line with just aligning this issue of what a financial service is and what is not, there is clarity on the definition of who a payment service provider is. There's also clarification on who a tour operator and what in-house supplies in the tour sector entail. And the reason the payment service provider definition has been introduced is to clearly delineate that any fees that are earned by payment service providers are vatable. And basically, a payment service provider is a person who owns, possesses, operates, manages, or controls a public switched network for the provision of payment services, or any other person, company, or organization that processes or stores data on behalf of such payment service providers or users of such payment services. So for payment service providers, then those fees are actually outside the scope of what is VAT exempt. Then I think for tour operators and the tourism industry, what is critical to note is that tour operator services are VAT exempt. However, if such a person involved in tour operator services is not licensed as an operator by the competent authority, then the tour operator services do not qualify for VAT exemption. So it's an issue of sort of a regulatory safeguard that has been put in place to ensure that it is only those tour operators who are licensed who will enjoy the VAT exemption on the tour operator services. Then there is further clarification. In as much as tour operator services are VAT exempt, there are those tour operators who have what we call in-house supplies. And basically, in-house supplies means supplies that are made from a tour operator's own resources. And a typical example would be you have a tour operator who owns a hotel. The aspect of the fee that is charged to the customer excludes any in-house supplies. So if part of the tour package entails accommodation or transportation that is owned by the tour operator, that element is subject to VAT. And it's not only an issue about the tour operator owning those supplies. It's also a matter of if the tour operator has actually bought this from a third party, but has materially altered so that the supply is made substantially different to that was purchased, then that also forms within that scope of in-house supplies that or over and above the tour operator services being VAT exempt. There would be a requirement to account for VAT on those in-house supplies. Other proposals that were enacted. Basically, there are some reclassifications of the following items from VAT exempt to taxable. And we have any taxable goods and services for the direct and exclusive use in the construction of the tourism facilities, recreational parks of 50 acres or more, convention and conference facilities, obviously upon recommendation by the CS responsible for those matters. You can see there is a bit of emphasis touching on the tourism sector, and that could potentially have a negative impact in terms of Kenya's competitiveness because of the increase in the tour packages because of introduction of VAT. Then also goods imported or that are purchased locally for the direct and exclusive use in the construction of houses under the affordable housing scheme that were previously VAT exempt will be subject to VAT at the rate of 16%. And that begs the question in terms of basically the overall cost that developers or those involved in affordable housing projects in terms of the costs that they'll have to bear. Then you have direction finding compasses, instruments, and appliances for aircraft that were VAT exempt are now subject to VAT at 16%. Maybe on that topic, touching on aircraft, just to emphasize that all goods and parts of Chapter 88, which basically covers aircrafts and aircraft parts, are still exempt from VAT. Then there are certain items that have been reclassified from the general rate of VAT of 16% to exempt. And we have dialyzers of tariff number 8421.29. We also have scrap metal, now has been made VAT exempt. Then we have undertaken under a public-private partnership, a PPP, but this is upon recommendation by the CS for the ministry responsible for the implementation of the project. If we move on, there were certain items that have been reclassified from zero rated to VAT exempt, and those we have inputs for raw materials locally purchased or imported for the manufacture of pharmaceutical products upon recommendation by the CS responsible for health. And obviously that exemption then would have to see if it has an overall impact in terms of pricing. But then remember, if these inputs and raw materials have actually been VAT exempt, that would actually form the major component of exemption of input VAT. But then you would have other input VAT that is incurred that would ordinarily be loaded into the cost of the pharmaceutical products. Then bioethanol vapor stoves of tariff 7321.12 have equally been exempt from VAT from the current zero rated status. Then we have new changes that have been introduced by the Finance Act 2026 that were not there in the bill. And the very first change is a very important one, because we must be aware of a ruling that was issued that was touching on outsourced, basically BPO services, where you find an organization has decided to outsource, for example, its payroll related processing services to a third party. And you find that the person who has outsourced would actually be transferring the salary related costs and would also be paying for the service being provided by the outsourced company. And the ruling was quite bizarre, because basically VAT was also being applied on the salary related costs. So basically the amendment through the Finance Act 2026 has clarified that any such direct costs, like those salary related costs, are considered to be disbursements and will be excluded from the taxable value for VAT purposes. And it's only the portion that relates to the outsourced service cost that will be VATable. Then there is an introduction of VAT exemption from supply of goods for direct use in infrastructure projects. And I know there's a lot of emphasis now by the government when it comes to infrastructure projects. So I think that is just exemption on plant, machinery, equipment, and spare parts for projects with an investment value of at least 3 billion Kenya shillings. I believe it is a welcome amendment, but then the question is how many investments would have hit those high thresholds. Then specification of tariff headings for the supply of electric bicycles and solar and lithium batteries. So I think the important thing is that for the solar and lithium ion batteries, and as we'll see in some of the proposals that were dropped, those have retained their VAT exempt, their VAT zero rating status, as well as electric bicycles. I think the only exception is that if the electric bicycle is not motorized, then it will be subject to VAT. But for electric bicycles, those are still VAT zero rated. For those of us who supply items to certain specified security departments. We have the Kenya Defence Forces, the National Intelligence Service, the National Police Service. You're actually allowed now to claim input VAT deduction despite any supplies to these specialized security departments being VAT exempt. Then there is also an introduction of VAT exemption on taxable goods and services that are used in the construction of liquefied petroleum gas storage tanks. Equally, there is an introduction of a VAT exemption, and I think this is based on previous litigated matters, where basically VAT exemption will also be applicable on the making of advances or granting of credit, which is still the case because it's considered to be a financial service, but that will also include any consideration that is realized on collateral. So assuming a financial institution basically realizes a collateral, there will be no VAT that will be applicable on those proceeds from the realization of the collateral. That will still be considered to be a VAT exempt supply. Then there's also an introduction of a VAT exemption for capital goods that promote investment in the manufacturing sector. If you might recall, this provision used to exist in the repealed VAT Act prior to VAT Act of 2013. And I think this is a welcome move in terms of spurring growth in the manufacturing sector. And as Alpesh had previously mentioned, I think the manufacturing sector is not doing very well. So this slide contains the proposals that were dropped from the finance bill. And the first one was that is specifically the denatured ethanol of tariff number 2207.20 that had been proposed to be general rated. It still maintains its VAT exempt status. Then equally, we have worn clothing and other worn articles, as well as human blood, animal blood, prepared for therapeutic medical procedures that are proposed to be exempt. They still maintain that they are general rated VAT status. Then other proposals that were dropped, some items were zero rated and they were proposed to be exempt. That is inputs or raw materials for the manufacture of animal feeds. Those retain their zero rated status. The transportation of sugarcane to farms for milling factories, that remains zero rated. The supply of motorcycles of tariff heading 8711.60, those that are not motorized, basically electric motorcycles, maintain their VAT, their zero rating status. The same to solar and lithium-ion batteries. The same to the supply of electric buses, as well as the supply of imported or locally purchased telephones for cellular networks and other wireless networks. So that remains zero rated. I'll quickly move to the excise duty amendments, just to follow the same process. Now, for excise duty, you will note that a majority of the proposed changes were proposing to change the description, which is on the second column, as well as possibly introduce a new rate. Now, on our presentation, we have several tables, and we will not necessarily go through each and every item, but maybe just highlight. And you see, when we're having a discussion on excise duty, we are basically talking of sin taxes. And that's why you can note that these proposals that were there in the bill that have been enacted, some of them touch on alcoholic beverages. You can see the first one, you have spirits of undenatured extra neutral alcohol. The amendment is actually a change in the description, as you can see, to a simplified description of spirits of undenatured extra neutral alcohol of alcoholic strength exceeding 90%. The rate was previously 500 shillings per litre, is now 80 shillings per litre. You can actually see proposed amendments in terms of increases in the substitutes. You can see the The amendment is really to increase the excise duty rate. I think if you look at the last item, imported ceramic sinks, wash basin pedestals, basically this is touching on furnishings for buildings. You can actually see there's a proposal to increase the excise duty by rebasing the 5% excise duty rate from the customs value to the excisable value, or 50 Kenya shillings per kg, whichever is higher. So you can actually see the resounding theme in that plot is, yes, there is an amendment in terms of the description. There is also a proposal to increase certain excise duty rates, which is sort of repeats itself in the next slide. I think an important one is for those sort of in the confectionery sector, where you have quite a substantial increase in the excise duty rate on imported sugar, but this excludes sugar imported by registered pharmaceutical manufacturers. You can actually see that substantial increase in the excise duty rate from 7.5 shillings per kg to 40 shillings per kg. So you can imagine the impact that will have to the pricing of a lot of confectionery products. Then you have imported ceramic flags and paving, hearth and wall tiles. You can actually see there is also a proposal to basically rebase the excise duty from the 5% of customs value to make it subject to basically the excisable value or 50 shillings per kg, whichever is higher. Then there is something touching also on the glass sector, but basically imported float glass and surface ground or polished glass. You can actually note that the amendment there is not on the rate. The rate still remains at 5% of the accessible value of 500 shillings per square meter, whichever is higher. But then what we need to be critical about is the description to make sure that if you're dealing with such products, those are covered. There is also amendments that are touching on the gaming and betting industry. And as you'll note in this slide for the gaming and betting, what is notable is there is no change in the rate. It is only that the descriptions have changed. And this goes in line with the explanation Kevin gave in terms of the amounts that are being subject to withholding tax on winnings as well as withdrawals. Is basically to align the same wording for excise duty purposes. Maybe what I can touch on is the very last item. It is important to note that bottled water you'll notice that in the wording, it was previously bottled or similarly packaged waters and other non-alcoholic beverages, not including fruit or vegetable juices. You'll notice that the word bottled or similar packaged waters has been dropped. So any bottled water now is not subject to excise duty. Then this slide looks at new changes that were introduced by the Finance Act of 2026. Just to touch on the first point, it is not that it is a new introduction. Maybe in our alert, you'll be able to see the clarity. There was a cleanup that was basically done with regards to the applicability of excise duty on imported articles of plastic. So there was a consolidation of two separate listings, but the position still remains. Excise duty is only applicable at the rate of 10% on imported articles of plastic of tariff heading 3923.30 and 3923.90.90. For locally manufactured articles of plastic, those still remain not subject to excise duty. I think we touched on this issue of antique, vintage, or classic vehicles that have a value of, I believe the figure was around 10 million shillings. So that excise duty has been retained at the rate of 50% on any such antique, vintage, or classic vehicles. Then there is sort of an introduction of excise duty on fruit juices, including grape and vegetable juice, as well as the last bullet there that is also touching on fruit juices of a different description. So you can actually see when we are looking at, and Kevin mentioned this Finance Act is supposed to raise almost 100 billion, and the question is, where is this additional 100 billion is going to come from? what is being manifested in these excise duty changes are new introductions that were not previously there in the bill. For example, if you look at the MDF, imported MDF, for those particular tariff, there's now an introduction of 30% excise duty on the excisable value. Same to imported particle boards, imported block boards, and imported plywood. And you can see what these impacts should have either to the furnitures and basically that sector in terms of increasing prices by virtue of the introduction of the excise duty at the rate of 30%. Similarly, there is a lot of emphasis in sort of timber when it comes to timber, imported timber as well, subject to excise duty at the rate of 30% of the excisable value. Then because of the introduction of excise duty, imported shower heads, whether or not fitted with heating elements, including fully assembled units designed for domestic or commercial use of those particular tariff heading, that is 85.16.10. There's a 35% excise duty on the excisable value, as well as imported heating elements that are exclusively used for the manufacture of shower heads. So you can actually see the impact on that in terms of pricing. Then we also have excise duty that is that was introduced on oral smokeless tobacco products. You can see the emphasis on basically the sin taxes. Then you have unprinted plastic sheets of tariff 3920.43. There's a 10% excise duty on the excisable value, as well as pre-personal chip modules of tariff 8542.31. There's a 10% excise duty equally. So there are certain proposals that were dropped. I think the notable one is for those people who are in the business of supply of cellular phones. There was actually the proposal to increase the excise duty from 10% to 25%. That proposal has been dropped, so the excise duty remains at 10%. Then I think the notable changes here will be actually, so all these were dropped. In a nutshell, I know the previous basically the finance bill had articulated that there was either an intention to change the description of the product or to introduce a new rate. All these items have been dropped. On this particular side, what I want to focus on is this issue of the proposal that was there in the bill. For example, if you look at the first item, where we have imported other self-adhesive plates, if you read that entire description, there is that part that starts with, but excluding those originating from the East African Community partner states. The proposals in the bill was actually to do away with the exclusion of those items that are originating from EAC, which would basically have meant that even if those items are being imported from EAC, then they will be subject to excise. By dropping these proposals, then any such proposed amendment that was excluding that bit of the EAC, it means they've been dropped. So anything that comes from EAC, even if it's the East African Community, even if it has that description, then it will not be subject to excise duty. I won't go through each and every of those items. You will note that even in this next slide, anything originating from EAC, with the dropping of entirely of these proposals, then that means anything that comes from EAC that is particularly with this description is still not subject to excise duty. And the same is repeated in the subsequent slides, which I don't want to go through specifically item by item. Now, all these details that you are seeing will actually be contained in our detailed alert. So for any businesses that are dealing with these particular products, then you'll be able to clearly see what has changed and what has not changed. If it is a change in the description, you will see what the description is. If it is a change in the excise duty rate, then you'll see that. I think the very final one, there was a proposal to actually increase the excise duty rate on coal from 2.5% of the customs value to 5%. That has been dropped. So excise duty on coal still remains at 2.5% of the customs value. So I'll quickly go to the customs duty amendments. And for customs duty purposes, remember, any such amendments are normally done at an East African community level. And we had the opportunity to quickly go through the East African community, East African community, basically Gazette notice. And what we've highlighted are some of those amendments that are contained in that Gazette notice. And you'll notice that all these items that are listed, there's actually what the amendment particularly is. And I think it would be important for all businesses that are actually dealing with these items to just counter check and see, and you'll be able to see what these amendments are. So, for example, for the second item, that is lubricants in liquid form, basically the duty rate has moved from 25% to 25% or 46 cents dollars per liter, whichever is higher. So further details of all these amendments from that are contained in the EAC Gazette notice will be in our detailed alert. But maybe just to move on to the next slides, and then a good example, like the ninth item, where we have finishing ceramics. That's basically the duty rate has moved from 35% to 35% or $3 per square meters, whichever is higher. Then you have nails, tacks, drawing pins, corrugated nails. I know there are a lot of people who will deal with those items in respective sectors. Similarly, the duty rate is moving from 35% through these items and focus on the critical one. An important one, basically listed raw materials and inputs for the manufacture of garments and other made-up articles. You will notice that this slide now contains items that have been remitted from duty, that have a duty remission. And you'll notice that each of the East African member states actually puts forward proposals to either have duty remission on certain items. Like, for example, on the first item, you see that Rwanda, Kenya, Uganda, and Tanzania were granted a duty remission on raw materials and inputs for the manufacture of garments and other made-up textile and products as per that EAC legal notice. Similarly to the next item there, then you have hard wheat of that particular tariff, where you have Tanzania and Kenya being granted a remission of duty to apply a duty rate of 10% instead of 35% for 1 year. Then you have white refined sugar for industrial use, that is originating goods from the Republic of Kenya or Tanzania, manufactured using sugar for industrial use at the regional remission rate of 10%. Will be accorded a preferential tariff treatment when transferred to Uganda. So you can actually see there are profound amendments that are contained in the EAC Gazette notice. Another important one is for manufacturers of telecommunication devices, where we have inputs for the assembly, manufacture of smart telecommunications devices, including laptops and tablets. Kenya has been granted a remission of duty on imports for the manufacture of these devices, including laptops and tablets, and to apply a duty rate of 0% for 1 year. Then you can see another profound amendment touching on inputs for manufacture of animal feeds. That is the second item, where Kenya was granted a remission of duty of 0% on raw materials used in the manufacture of animal feeds for 1 year. So you will notice that we will actually provide further details of these, but it's important also to understand from a customs perspective what is really affected from that perspective. So many a times you will find it's either a stay in application of a higher import duty rate, or it's a matter of granting of duty remissions on particular products. Okay, on this slide, I don't want to go through the items one by one in the interest of time, but all these details will actually be provided in our from a customs perspective. So that brings me to the end of the amendments introduced by the Finance Act 2026, touching largely on indirect taxes, VAT, excise duty, as well as customs. And I take this opportunity to invite my colleague Ken to take us through the next presentations. So thank you for your time.
Okay, thank you very much, James, and for all the presenters before, Kevin, Rupesh, and Lena. Today we'll be taking us through the proposals that actually had been provided in the finance bill that were enacted in the Finance Act in the same format, and those ones that were dropped, and any additional provisions that were brought in by the Finance Act 2026. So to start us off, there was actually an exemption for non-residents who want to operate investment funds and financial institutions, and the Tax Procedures Act now exempts the requirement for a PIN whenever non-residents are opening up a bank account with an investment bank or a financial institution. Yeah, and this is just purposes for the investments. The next change that was retained is actually the tax assessment for taxpayers who benefit from tax avoidance schemes. So this is basically the commissioner being empowered to be able to issue an assessment for any taxpayer who they had whose main purpose of getting into that arrangement was for the purposes of obtaining a benefit. Yeah, so the tax avoidance has actually been provided to say if it's a scheme, whether it is a proposal, whether it is any sort of arrangement you get in whose main purpose is actually to avoid the payment of a tax liability. And that includes postponing the payment of that tax liability. It means reducing whatever output tax you would have paid or getting an input VAT deduction and such other sort of arrangements. So when the commissioner gets some of that information, what it means that he's actually empowered to issue a tax assessment to you. And this is one of the things that we are saying about how aggressive we are seeing the tax money is getting following the enactment of some of these proposals from the Finance Act 2026. The next one was the reintroduction of the tax amnesty, which is a very welcome. The last tax amnesty covered the periods up to 31st December 2023 and December 2025 are going to be covered by this tax amnesty. And what the tax amnesty allows you to do is for the next 6 months, unfortunately, the period that has been given for the taxpayers to actually correct their tax position is what is minimum. So it gives you 6 months for between now and December 2026 to be able to have gotten into an agreement with the Revenue Authority and a payment plan and complete paying for those specific taxes. So what happens is if by end of December you will not have completed the payment of the principal tax, there's going to be an apportionment in terms of the amnesty from the penalties and interest that you get. Yeah, so this is actually a very welcome move, but unfortunately, the time that taxpayers have been given to be able to comply is so minimum, and it leaves you wondering what the rush is about, considering financial year lasts 12 months. So you would expect that they would have been more lenient, but unfortunately they were not. So it means that we have an opportunity for tax liabilities before 31st December. This is a good opportunity to be able to get that cleared out. Another thing is the introduction of penalties for failure to comply with the electronic tax system requirements. Yeah, so this had actually been proposed by the Finance Bill and it was retained in the Finance Act. And the penalties for failure prior to the enactment of the Finance Act, the penalty was actually double the tax due. And so what the Finance Act has actually come to do is it has sort of expanded it. So the penalty of double the requirement has actually been removed, and now a 5% penalty applies for failure to comply with this. And what has happened is they've actually introduced sort of a minimum amount of penalty that would be applicable. So it's 100,000 shillings for companies and 10,000 shillings for individuals. Yeah, so this is just the Revenue Authority trying to be able to penalize, to make it more strict so that taxpayers are able to comply with the electronic tax system requirements. Another one was the introduction of the virtual assets and the virtual assets provider definitions. And this was following the enactment of the Virtual Asset Service Providers Act of 2025. So what the Tax Procedures Act, the definitions that are provided for in that specific act have been adopted for the Tax Procedures Act. So basically, a virtual asset is an item that you can be able to transfer. So it is a digital representation of value that can be transferred or that can be used to trade. Yeah, and it excludes any digital representation of a currency, and I think that is very important. So any digital representation of a currency is not covered under this proposal. So it is going to capture assets that on their own are actually tradable. So we are talking about crypto and all those other type of virtual assets. The next step was giving the commissioner powers to enter into an automatic exchange of information on virtual assets. Yeah, and so what this Finance Act 2026 has done is it has provided requirements for there to actually be filing of returns for virtual asset service providers, and they'll be required to report on any transactions that have happened within a year for specific for the people who they've been dealing with. And now this additional one, it now grants the commissioner powers to enter into an agreement with another country. So it can enter into an agreement with Tanzania to be able to automatically exchange information on virtual assets. Another thing that has been mentioned, Kevin mentioned about the introduction of filing of returns using pre-populated returns. Yeah, and this just shows you how there has been a move, we're moving away from the self-assessment where the Revenue Authority would take a backseat. Now they seem to want to take a more aggressive approach in terms of pre-populating your returns. And they have given that by the end of January, they'll be able to issue the pre-populated return, and they'll give you 2 months to be able to make any amendments or to confirm this. Yeah, and so it leaves us with a lot of questions, and I think some of them Kevin brought up. What happens to taxpayers whose NDI is not 31st December? If you're 30th June, what happens if they issue you with a pre-populated return by end of January? That is way past already your filing deadline. And so there's some things that will need to definitely be worked on when it comes to the pre-populated returns. But something we want to point out is that the commissioner is actually empowered to issue regulations on how pre-populated returns are going to be carried out. So maybe this will be an opportunity for all these questions that we have once the commissioner has issued the regulations, then it will be a lot clearer on how these populated returns will be done. Another provision that was so Alpesh gave an example of a taxpayer who was actually being re-registered so that they could be able to recover taxes. So a similar provision has been provided in the TPA that they can actually issue that same taxpayer a PIN, which was the PIN that they had before the deregistration. So these are some of the provisions we are seeing that the taxman is trying to he's becoming very aggressive in terms of tax collection and the powers in which the commissioner will have. Another provision was the power to issue assessments based on available data, including from third parties. I think we had mentioned on this. And maybe what you can mention is the places where the commissioner can get this information. So if you have returns, withholding tax that has been deducted by your supplier, the pay that your employer has deducted, and information that they go recover from third parties, including for example, the information on the virtual assets providers. So that information they can actually use to be able to issue an assessment. Yeah, anything they get from a KRA audit or an investigation or any other source, they can actually use that to be able to issue you an assessment. Yeah. The next part was the commissioner being empowered to waive penalties and interest, but to a limit of 2 million shillings. Yeah. So this provision was actually retained, and the same questions remain: is are we getting to a point that the revenue authority can only accept risks of up to 2 million shillings? Yet the system generated errors do not have a limit. It does not require a special approval if an assessment is above 2 million shillings, so that you can be able to say that there is a safeguard for us not to get into those system generated errors. So it just leaves you, well, it's a welcome provision to some extent by the fact that there were actually no provisions prior to the introduction of this and the waiver of penalties. So there is a very big question that what happens to system penalties that are above the 2 million shillings, and that is a question that the Finance Act does not answer. But in this case, we know that you'll have to go through a much longer process when it comes to waiver of the penalties that are above the 2 million shilling threshold. Empowering himself to collect any unpaid fees, levies, or other charge under any written law. Yeah, so this would be specific fees and levies where the KRA has been appointed as the collecting agent. Yeah, so we have something like training levy or affordable housing. So now it means that they can be able to go and collect other levies where they are actually the collecting agent. So this gives them that very clear provision to be able to do that. Another thing was the requirement for importers to obtain, retain, and produce export documents for imported goods. Yeah, so prior to this introduction, you are required to provide the certificate of origin from the competent authority of the state in which you're importing from. And now this is an additional one that now it sort of expands that for an importer, what you do need to do is actually obtain document. And the export documentation, they have given an example. So we are talking about like an export declaration, we're talking about an export entry, so items like that, and they have given exactly what needs to be in those documents. And it is basically for the taxman to be able to follow through that. If you import a product right now, they can come in and you're required to retain these documents for 5 years. So within that 5 years, they can come and verify that you actually did, import these goods, and it will go to show, the nature, the type of the good, when it was imported, the classification code. And an important thing is a reference to the competent authority of the other end of the other company. So you still do need to have a record from the other entity that's exporting that is going to now come into your export documentation, that you will keep, that they can come later and be able to know that you actually did seek that from the competent authority of the other country. Yeah, so this is just sort of expanding, not just requiring the certificate of origin. Right now, you can actually provide these other documents, and they'll be sufficient for the commissioner to not issue a post-clearance audit. Another thing is the proposals that were dropped from the finance bill, and I think some of these were very, very welcome. It was a sign of relief for taxpayers. The first one was the removal of the restriction from issuing agency notice on matters under appeal. Yeah, so what the finance bill had proposed to do is remove the restriction where the India. So if the TAT has given their ruling, once you have objected to that, then that means that you are actually the KRA could not come and issue an agency notice. So it's a very welcome move by the fact that as long as the process is undergoing, then the taxpayer is confident that you'll not wake up and receive a letter tomorrow from the revenue authority requesting for that your accounts have been locked. Another thing is the revision of timelines for lodging objections and appeals. Yeah, so they had the finance bill had proposed to revert from using working days to calendar days, and that this proposal was dropped. It means that right now the timelines for lodging objections and appeals is still based on the working days. The next thing was the removal of an exemption of liability. So this would be cases for withholding tax, where you're the withholding tax agent, so you have a supplier, and unfortunately, when you're paying the supplier, you forget to deduct withholding tax. So the Tax Procedures Act had actually said that you, as the withholding agent, would not be at liability. You would not have any liability. Where that, if the supplier has already accounted for the tax and paid it. Yeah, so it would avoid any instances of double taxation where I did not deduct withholding tax, but the person who actually got that revenue paid the actual tax, so that you don't end up having to pay the tax 2 times. Yeah. Another thing was the removal of the offset of the import VAT against overpaid tax. So they were actually trying to limit the number of ways you are able to utilize the overpaid tax. And by removal of this, it means that you can still now use overpaid tax to offset against import VAT. So if you have that equipment that you're importing from, India, and you have some import VAT, you can actually use an overpayment to offset against that import VAT. So these are actually very welcome moves, because these are some of the provisions that the taxman was trying to sort of stretch their sort of it is pay me now, then we'll sort out issues much later. So now it's welcome. It's a welcome move for taxpayers, such that now there is a sort of a relief in terms of that. Yeah, the next thing was there was a and they were planning to actually remove that requirement to have the certificate of origin, but this was dropped. So the requirement still remains in the Tax Procedures Act. And now this is going to be complemented by the one that we mentioned right now about requiring to have the export documentation for the next 5 years. Okay, that is all when it comes to the Tax Procedures Act. We'll quickly go through the changes per the Miscellaneous Fees and Levies Act. The first thing was the reduced scope of IDF and RDL, so that's Import Declaration Fee and Railway Development Levy on aircraft. Yeah, so prior to this, the exemptions only applied. The exemptions actually applied to all parts. So we are talking about all aircraft and all the parts. And what happens is now this the reduced scope means that now aircraft of below laden 2,000 kilograms are now going to be subject to paying IDF and RDL. For the aircraft above 2,000 kilograms, and the ones that are above 15,000 are going to continue enjoying that exemption, and includes also all the spares will continue to enjoy that exemption. The next one was stamp duty exemptions on the property transfers to rates. This was actually a very welcome move, and the fact that it has been retained, it's going to help spur the real estate investment trust space. Another thing we want to bring are the new changes that were not in the finance bill, but were brought in by the Finance Act. So the first one was an exemption from IDF and RDL on construction of LPG storage tanks. So they give a threshold of 5 billion shillings. So if you spend 5 billion shillings in the construction of LPG and similar infrastructure, then you do get that exemption from IDF and RDL. Another thing is there's an increased allocation in terms of programs and projects under the Affordable Housing Act. So currently what happens is of the monies collected under the Affordable Housing Act, so the Affordable Housing Levy, 0.5% is actually maintained, is allocated to creating programs and projects that are going to deal with this affordable housing, social housing, and similar kind of projects. And so what the Finance Act has done is it's increased what is going to be allocated from that 0.5 to the 2%. So it means that there'll be a lot more money in terms. Another thing was a reduction in terms of the amount that is available to the Road Annuity Fund. And this is a fund that is actually under the Road Maintenance Levy Fund Act. So the 25 shillings that you pay for petrol under the Road Maintenance Levy, 1 shilling, 3 shillings actually goes to the Road Annuity Fund. And this Road Annuity Fund, they're actually projects that are financed by that Road Annuity Fund, and they're approved by the National Assembly. So there has actually been a reduction of the allocation from 3 shillings to 1 shilling and 50 cents. Yeah, so, and I think this goes back to the fact that there has been a lot of increased pressure in terms of trying to reduce fuel prices and all that. And I think this is one of the ways that they're trying to allocate less money to things that were actually still being used under the Road Maintenance Levy Fund Act. Another proposal that had been dropped is so currently import declaration fee. So the amounts that are collected under the import declaration fee, 20% of what is collected goes into revenue enforcement activities. And what the finance bill had tried to do is to reduce that threshold from the 20% to the 10%. So less would have been available, but now it has been dropped. It means that now still the 20% will be available for the revenue enforcement activities. The next one was the exemption of IDF and RDL and imported telephones. I think there was that, the whole part of trying to change the taxation of telephones. This is similar to what had been done for VAT and excise duty. And so now what happens, they were trying to exempt to have just one tax on telephones, but this proposal was dropped. So IDF and RDL will still continue to apply on imported telephones. Yeah. So the definition of the East Africa Community Partner States, yeah, they had proposed to change it to now, it would basically have been Kenya, Uganda, Tanzania, and any other country that comes into this sort of agreement. But now it is retained as it currently is. So those are some of the proposals that were issued by the Miscellaneous Fees and Levies Act and other proposals. Thank you very much.
Thank you very much. Very grateful to our presenter, and thank you for staying up to now. Now we'll take the questions. First question goes to Apesh. Apesh, given that the forex rate, what's your perspective on how long the monetary policies in Kenya?
Yes, I think it's a good question. I think a lot of people have been asking the same. As I mentioned also in the presentation, there is pressure from IMF and World Bank. If you have an inflation of between 5 to 7%, how are you able to maintain your exchange rate very stable for the last 2 years? I think the answer to that is, I think, first of all, it's sort of a government public debt. As I said, we are now about 45% is foreign. I think the government has also realized that 2 years back, when the currency really depreciated, they took a big hit of the exchange loss. So they've been trying to manage it. There will be lots of good inflows, to manage the monetary policy. I think what's going to be important is to see how long the forex reserves are going to be stable, especially with what's happening now with the war in Iran. Oil prices going up, there's a lot of pressure by oil at higher prices in time to come. And we all know that the Central Bank of Kenya is intervening in the market to manage the exchange rate. I think the key issue will also be as to how what will be the reaction from the Fed in the US, the European Central Bank, Bank of England, to how far they do raise the interest rates. I think the oil price, the interest price will be a determining factor, and of course, the inflation rate will be a determining factor as to how stable the Kenyan exchange rate will be. And more importantly, what's important for us is to compound the issue further is that we have elections next year. So I don't have any right or wrong answer. I think it's important to acknowledge and to keep an eye on what's happening globally to see what impact it will have on next generation change.
Thank you. You say that next year there is elections, yes? So the next one is what would be your expectations when that's an election year on the economic growth and investor appetite?
I think just like any African nation, I think whenever we hear the elections, things start slowing down, but it's a perception that we do it. There's no doubt that there will be some kind of slowdown. But again, it's not just the Kenyan elections. As I said, we have this global issue that the wars that's happening in the Middle East that will have a greater impact on us. I think the good thing is that the people sitting in Central Bank of Kenya, National Treasury are very, very intelligent. I'm very much impressed with the CBK governor, Governor Thigi. I think he has eyes on what's happening down there, and I think he's got a good team around him as well. I think we should be able to manage the situation. And for us, the Kenyans, we have the Mandamanos, we have the protests, we have all kinds of issues, but Kenya is a strong economy, we're very diversified.
So the next question are for income tax. And Kevin, please clarify regarding the minimum distribution requirements and whether businesses can justify non-payment of dividends based on investment requirements and plans.
Thank you, Lena, for that question. And indeed, a very important question. So when you go to Section 24 of the Income Tax Act, it prescribes that where a taxpayer has not distributed dividends, the commissioner is empowered to direct a distribution of dividends. But it also gives a caveat that that distribution should not or should be taken without prejudice to the requirements of the company's business. So, as much as the commissioner is empowered to direct a distribution of dividends, the commissioner should also take into consideration the financing needs of that business. And in that case, as a taxpayer, you're supposed to demonstrate, yes, you're not distributing dividends because you intend to build up on your reserves to undertake maybe a certain project, or there's a project that is currently in place that is being financed by those reserves. So yes, indeed, as a taxpayer, you have the right to demonstrate to the commissioner as to why the non-distribution of dividends is not happening. So the commissioner cannot just come and find that because you didn't distribute dividends, they deem everything to be distributable and demand withholding tax out of it. It has to be a discussion with the commissioner, and the commissioner you have the right as a taxpayer to demonstrate to the commissioner the reasons as to why you're not distributing those dividends.
Okay. So it's a duty of the taxpayer to be able to show why they're not distributing.
That's correct.
The next one is please clarify what is meant by digital payment infrastructure. Does this include payments for software licenses and subscriptions?
Very good question again, and it's important to get that clarification that this is, I believe that question is tied to what we have discussed, that any transactions that relate to a proprietary digital payment card network or platform will be subject to withholding tax as a royalty. Now, if you look at that introduction in the Finance Act 2026, it only covers transactions that entail an infrastructure that enables a card payment network transactions, service fee, or network fee. So this one does not go into issues to do with software subscription and access. It only covers on card transaction. However, on top of that, please remember that any payments that you make for the right to use a software is also deemed to be a royalty, because that is taken to be payment for use of someone else's intellectual property. And that has again been subject to litigation in other cases. And we have several cases, notable cases like the KCB enforcing system case that do that any payments that you make for the right to use a software is a payment for right to use someone else's intellectual property, and in that case is a royalty subject to withholding taxes at the prevailing withholding tax rates, depending on whether there is a double tax agreement.
Thank you. So it means that if it doesn't fall under the digital payment, should be careful about the definition of what a royalty is. The subscriptions would follow there.
Correct.
The next one, we mentioned about withholding tax on scrap metals. So how do these apply in the ambit of double tax treaties?
Thank you for that question again, Lena. Now, so the introduction through the Finance Act is that payments or transactions relating to scrap metal will be subject to withholding tax at the rate of 1.5% for both residents and non-residents. Remember, withholding tax is an obligation, or the obligation to account for withholding tax is of the person who is making the payment. So the person making the payment should be required to deduct withholding tax at the rate of 1.5%. Now, the other aspect of that question was in relation to double tax agreements. Now, it's important to mention that double tax avoidance agreements do not on themselves impose a tax. What they do is that they avoid instances of double taxation. In that case, the primary taxing statute remains the income tax of the respective country. Now, in that case, for a double tax to provide a relief, the tax has to be in the primary taxing statute, which is in the Income Tax Act of Kenya for this case. Now, if you look at most DTAs or double tax agreements, they will not have such a provision on scrap metal. The Income Tax Act is the main primary taxing statute. So you'll find that in most of these scenarios involving scrap metal dealers, where they are non-resident, you will not have or you will not get any relief from the double tax agreement. And the tax prescribed under the Income Tax Act at the rate of 1.5% will be or will prevail in that instance.
Thank you. So if it's not in the DTA, then the domestic law will apply.
Correct.
So the next questions were indirect tax. James, you mentioned that the question is for you to clarify on the VAT, the treatment on outsourced payroll, and whether this also means that such payments are not subject to withholding tax. Also, what's the effective date and the change perspective?
Yeah, thanks, Lena. Yeah, so I think on that issue of outsourced services, I think what is clear and the takeaway point is that this amendment is very critical because of the previous judgments that have been issued that came with a very profound VAT implication. Because you can imagine the bulk of the fee that as a business I will be transferring to the outsourced service provider would actually be, for example, the salary related costs and any deductions for the employees. So I think that amendment is a welcome move because then it settles the issue of VAT. Similarly, from a withholding tax perspective, remember these amounts, the way the VAT Act has described them, these will actually be considered to be disbursements. So these are disbursements and they are not in respect to the provision of the service. I think the outsourced service fee is clearly defined, and that is the only element that will be subject to withholding tax. So the other disbursements, which would be sort of call them the reimbursables, those will not form the scope for withholding tax purposes because they are not part of management or professional fees.
Okay, the next one is on meetings. What are the requirements for domestic property landlords? Do the landlords need to register and supply its invoices even when the income is not subject to VAT, and the tenant does not need to claim the expense as an individual?
Yeah, good question. I think I don't know if it was directed to me, Lemon, but I think the other panelists can also chip in. I think the issue of ETIM's invoices is actually a requirement now for all businesses. So there is the aspect of if I am a business and I'm so you see the discussion on ETIMs is more of a bigger discussion. Number one, ETIMs is actually supposed to address the challenges that the government has always had when it comes to the taxation of the informal sector and the hard to tax sector. So it's basically to bring everyone within the net so that there's visibility. So ETIMs requirements, whether you are VAT registered or not, regardless of what business activity you are carrying out, whether it is rental income, whether it is consultancy service, whether it is the sale of goods, you're actually supposed to raise an ETIMS invoice. An ETIMS invoice does not mean it must be an invoice with VAT. Now, and that is notwithstanding the fact that maybe you are dealing with someone who is not entitled to claim input VAT, or whether you are dealing with maybe someone who is under the turnover tax regime, for example, who normally or MRI, monthly rental income tax, who just declare their taxes on a gross basis. The requirement to generate an ETIMS invoice is applicable to everyone. Remember, failure to have an ETIMS invoice will have an implication. And I think from the year 2026, I think is when we will face the real music when it comes to filing income tax returns, because I think in 2025 we're only given reprieve. I would say reprieve in quotes, because I'm sure KRA will come and do audits and query all the expenses that were either put in audit adjustments as non-ETIMS. But I think ETIMS is critical because I think 2026 going forward, without an ETIMS supported invoice, then you cannot be able to claim the expense. So I think ETIMS is an overarching principle, like provided you are in business, just know that you have a requirement to generate an ETIMS invoice, regardless of your VAT registration status, regardless of whatever business activity you're involved.
Thank you. So ETIMS is not optional regardless of if you're, because even the individual would still need the receipt to be able to claim their expenses. The next question is to Ken. Ken, you mentioned that there's a tax amnesty. Does that cover all taxes and penalties that arise up to 31st of December 2025? Also, what happens for periods ending after December 2025, such as 31st March 2026? So assuming someone still hasn't paid and they so the 31st March, does the amnesty cover that?
Yeah, that's a very good question. I think in the strict interpretation of the law, it is going to cover all taxes that are due up to that specific date. A taxpayer who has that, it means that those additional 3 months will not be covered. And the thing is, it is going to cover all the periods before that, and it's going to cover the taxes applicable.
The next one is on the pre-populated returns. Does this in effect mean that the taxpayers will have only 3 months to finalize their numbers to have any opportunities to pay the correct taxes? Does this conflict with the 6 months deadline for tax returns filing?
Yes, yes, that's a very, very good question. And we have actually been asking ourselves the same thing. Yeah. So the Act actually does provide that, by 30th January, I think there was a first issue of what happens to non-December year ends. The second part is, yes, once they have given you that 1 month, they have provided you the pre-populated returns and the 2 months for you to be able to sort of engage the KRA and come up to a final position. Yeah, so it leaves you wondering then why do you have the requirement for 6 months if you have to have agreed by the end of March? So there are all those questions that are unanswered, and unfortunately, we'll only know once we cross the bridge there. And that's what I'm saying. We're hoping that they will actually issue regulations that will at least be able to streamline all these issues that we are going to encounter. Yeah, because it does not make sense if I have to by 31st March, I have to have the final position, then I haven't even started my audit probably. So why are you telling me I need to file 2 months later? So those are some of the discrepancies we are seeing, and we're hoping the regulations can sort that out.
So we are going to wait and see. All right.
Absolutely, yeah.
Thank you so much, our panelists, and thank you, our client and our business partner, for joining us. It's been a pleasure. And thank you so much for staying with us, even with the technical issue at the start. We really are grateful. Everything that has been said here will be done in a finance alert, which we shall share, and the presentation shall be circulated after the webinar. We'll also issue CPD certificates to the attendees. And also, of importance, you can see on your screen, you have a seminar invite coming up for a seminar for transfer pricing and international tax compliance for multinational enterprises. So in case you have any related parties out of Kenya, this would be your seminar. It will be on the 16th and 17th of July, this coming week, at the Radisson Blue Hotel from 8:30 to 4 p.m. And the damages are 60,000 per person. This will be really good for you. Please kindly, you can register, and there will be CPD hours awarded. More than that as well, we have tailored instrumentation. We want to continue beyond the webinar. We want more face-to-face for your finance teams, and any other service that we offer. We'll be more than happy to assist with the training to you and your departments. Thank you, and special appreciation goes to you, our clients, to the business organizations and professionals present, to the Kenya National Chamber of Commerce and Industry, to the Kenya Association of Manufacturers, the Netherlands Business Hub, the French Chamber of Commerce in Kenya, British Chamber of Commerce in Kenya, Association of Retirement Benefit Scheme, Italian Chamber of Commerce in Kenya, and our team behind the webinar. It's been a real pleasure. Till next time, I've been your host, Lena. Thank you.